Welcome to ETM Analytics' first take of the market. I'm joined by Director George Glynos. Now that all the public holiday hoopla is done and dusted, everyone is back at their desk. Trust me, I'll know. The traffic in Cape Town this morning was a peach. But George, before we get to the main event this week, which is the Federal Reserve's decision on Wednesday, let's just stick to domestic issues. We saw the ABSA PMI come out on Friday. It was the sixth contraction in the index. It's not painting a very rosy picture of the manufacturing sector. And in fact, ETM's own internal PMI is actually more depressing than that. So we will be looking to this week's manufacturing sector to what? To give some context, to give some relevance to how bad it actually is going?
Yeah, so the PMI, just remember, PMI is a survey. The manufacturing production figures are actual data. So we're looking for some clarification on whether the PMI reading is indeed as bad as all that and reflected in the manufacturing figures. But we've seen the manufacturing and mining production figures recently not looking good. So both have been trending lower. Both have disappointed quite strongly to the downside. Turns out that the big constraint on the industrial sectors of the South African economy weren't just about electricity. They're deep-rooted issues that are driving that as well, and it ranges from failing infrastructure to lack of confidence to a weakening economy that has deindustrialized over time, logistics that aren't in the country's favor, in other words, ports and rail, as well as regulation. So you combine all of that together and you begin to understand why it's just not a particularly attractive country to either mine or manufacture in. And I think, increasingly that's what's coming to pass. And it's a big red flag to our policymakers to focus more squarely on things like our industrial policy, manufacturing, mining, the almost primary and secondary sectors of this economy that really need support if we are to have some sort of an industrial base. Alternatively, we're going to be morphing into this fourth industrial revolution, which is going to exclude by far and away the large part of this economy due to a lack of skill set. So, we're stuck in a pretty awful predicament where the policymakers really have to pay very close attention to these manufacturing figures. They're not good. And on top of it now, we have all sorts of tariffs and whatnot that are going to impact negatively. AGOA is kind of like a lost cause due to the tariffs. So for all of these reasons, we need to refocus our thoughts on how we stabilize this industrial sector, because it's no longer just about electricity.
You mentioned tariffs. It's Monday morning. I feel every Monday morning we kind of have to do a stock take of new Trump announcements that came out over the weekend. I saw him mentioning tariffs to protect Hollywood. There was some information coming out on Truth that they will sanction anyone trading with Iran due to the ongoing negotiations, which will be an interesting development to track, given the bearish oil prices in the markets at the moment. So interesting to track that. But obviously the significant one is Trump calling on the Fed to move on interest rates. It comes on the back of a better than expected labor report in April. We are seeing the equity markets, they're stabilizing. This places Powell and his team and the Fed in a very interesting position, because if they do decide that there's room for them to move on rates, it might look like they're caving to political pressure, which it might not be. So I don't know. This places them in a very difficult situation. But what's your call? How do you think Powell and his team is going to play this?
I mean, the peculiarity of this whole situation is that Trump wants the Federal Reserve to cut rates. That's understandable. At the same time, he implemented a whole range of policies that run against that. So, on one hand, you can see the logic behind it, and he's obviously trying to offset some of the negativity that the tariff announcements have had on things like stock markets, et cetera, although they have recovered somewhat. But really, this is of his own making. And so, it's a classic Trump situation where he's trying to shift the blame for underperformance onto the Federal Reserve. But the Federal Reserve's already cut interest rates several times. They still anticipated to cut interest rates another 3 to 4 times this year. It's not like the Federal Reserve is hell-bent on being ultra-conservative and not responding to market movements. They are. But at the same time, they've got inflation that's still slightly above where they would like it to be, and they've still got a labor market which remains strong. So they really are in no desperate need in order to loosen monetary policy. The other point to make is that bond yields in the US have remained buoyant. And that's not on the Fed. That is almost squarely on the Trump administration's handling of their fiscal position. This whole Doge thing was supposed to raise a whole bunch of money, which it's done to some extent, but really not to the extent people anticipated that it would. At the same time, Trump wants to implement a whole bunch of personal income tax breaks. Now, that's going to cost. And it's got to be funded out of somewhere. So people are really quite uncertain as to the impact that those sort of tax cuts are going to have on the fiscus. On top of it, the situation with the tariffs. I mean, this is the irony of a tariff, is that you implement it to potentially raise money for the fiscus, but if the tariff is successful, you should raise no money for the fiscus, because by definition it has stopped that trade. So it's almost like this very counterintuitive, lots of crosswinds blowing, and I wouldn't blame the Fed for wanting to let the dust settle on these tariffs before they take a decision. I suspect that that's what they're going to default to. And Trump needs to take a long, hard look at his own policies for why bond yields are as high as they are, and why the Fed has not found the flexibility with which to cut interest rates. So I think it rests quite squarely in his ambit, not the Fed's, and that over time that'll become clear. But let's see what happens. I mean, he's already repealed some of the tariffs. He's reduced the tariffs on China. He's given tariff breaks on auto manufacturers. One really doesn't know from one week to the next where we sit with these tariffs and what the ultimate impact's going to be. So I think the Fed probably opts to stay still, to do nothing, and to let the dust settle, so that they can understand what the implications of these tariffs are going to be. And if they do suffer criticism, the simple answer is, well, we don't know how to manage monetary policy because your tariffs are making things uncertain. That's the reality of the situation. I think most people in the market understand that. I think there would be a far bigger negative reaction to the Fed not cutting rates if it was deemed political. But at this point in time, I don't think it is, and I think Trump knows it, which is why there's no need for him to go after the Fed just yet. In fact, if anything, he knows that it would just heighten the amount of negative publicity and market reaction that he would generate, which right now is the last thing he needs.
Exactly. But apart from that, we're not going to get too in-depth into it now, but we can expect some domestic political noise as well. We know the DA is taking the Employment Amendment Act, Equity Act, to court. There are movements in the background as they prepare Budget 3.0. I think it's released next week. So expect a lot of domestic political noise to come on top of all the international developments happening. But George, thank you very much, and we will catch up again next week.